2 years ago, I would have told you that de-dollarization was mostly noise. Loud headlines, summit photo ops, vague communiques from BRICS meetings. But underneath the rhetoric, the dollar's structural position looked unshakable. I had good reasons for thinking that. The data supported it. Dollar share in foreign exchange transactions was still north of 88%, according to the Bank for International Settlements. U.S. Treasury demand remained robust. Every emerging market crisis, Turkey in 2018, Argentina repeatedly, Sri Lanka in 2022, ended the same way. Countries scrambled for dollars. The dollar wasn't just dominant, it seemed to feed on the instability of the alternatives. I was right about the data. I was wrong about what it measured. The data tracked the old system's activity, transactions running through SWIFT, reserves reported to the IMF, Forex turnover on established exchanges. All of it measured traffic flowing through infrastructure built between 1944 and roughly 1975. Bretton Woods institutions, dollar clearing networks, correspondent banking chains routed through New York and London. If you only looked at that infrastructure's throughput, the dollar appeared invincible, the equivalent of measuring landline call volume in 2005 and concluding that mobile phones were a niche product. What I missed, and what I think a lot of sharp analysts are still missing, isn't that the dollar is weakening. It's that the era of unconscious financial infrastructure is ending, and that distinction matters far more than any currency's market share. Let me explain what I mean by that, because this idea is the spine of the argument I want to make. For roughly 70 years, the infrastructure of global finance was treated like weather. It existed. You operated within it. You didn't question who designed it any more than you'd question why rain falls downward. When a Brazilian coffee exporter sold beans to a German roaster, the payment moved through a chain of correspondent banks, cleared in dollars through New York, with messaging routed through SWIFT's servers in Virginia and the Netherlands. The exporter didn't choose that path. The roaster didn't choose it. Their banks didn't choose it. It was simply how the system worked. The plumbing was invisible, and its invisibility was the source of its power. That invisibility is gone. The moment the United States froze Russian central bank reserves in February 2022, $300 billion rendered inaccessible by coordinated Western action, financial infrastructure became visible. Not just to Russia, to every finance ministry, every central bank, every sovereign wealth fund manager on the planet. The plumbing was suddenly exposed, and what countries saw when they looked at it was a system in which one nation held the master valve. This wasn't a revelation for specialists. Academics and central bank insiders had understood the dollar system's architecture for decades. But there's a vast difference between technical knowledge held by experts and political awareness held by decision makers. February 2022 converted the former into the latter. Finance ministers who'd never thought twice about where their reserves were custodied started asking pointed questions. Central bank governors who'd always denominated their portfolios in dollars by default began requesting briefings on alternatives. The questions weren't hostile, they were practical. What exactly are we exposed to? Who controls the infrastructure our economy depends on? What happens if the political winds shift and we're on the wrong side? The answers to those questions were, for many countries, deeply uncomfortable. Not because America was acting maliciously. You can debate the ethics of the Russia sanctions endlessly. But because the answers revealed a dependency most governments had never consciously evaluated. And that's the transition we're living through, not from one currency to another, from one relationship with financial infrastructure to a fundamentally different one. The old era was defined by countries using infrastructure they didn't think about. The new era is defined by countries insisting on infrastructure they control, or at minimum, infrastructure that no single external power can shut off. The implications of that shift run deeper than most commentary acknowledges, and they touch places far beyond currency markets. To understand how deep this shift runs, it helps to look at a country that isn't China or Russia, because those two get all the attention, and their motivations are obvious enough to be uninteresting. Look instead at Indonesia. Indonesia is the world's fourth most populous nation, roughly 280 million people. It's a democracy, a G20 member, a significant US trading partner, and nobody's idea of an anti-Western agitator. Its foreign policy has been carefully non-aligned for decades, friendly with Washington, cordial with Beijing, cautious with both. If there's a country you'd expect to quietly maintain the status quo in global finance, it's Indonesia. In January 2023, Bank Indonesia, the country's central bank, launched a policy it called the Local Currency Transaction Framework. The name is deliberately bland. The substance is not. Under this framework, Indonesia established bilateral agreements to settle trade directly in local currencies, rupiah and the partner's currency, with no dollar intermediation. By late 2024, Indonesia had signed LCT agreements with China, Japan, South Korea, Malaysia, Thailand, India, and several others. Trade between Indonesia and these partners, which collectively account for roughly 62% of Indonesia's total trade volume, could now settle without touching a dollar clearing system. Why would Indonesia do this? There's no sanctions threat against Jakarta, no geopolitical confrontation with Washington, no ideological commitment to de-dollarization. The answer is more mundane and more revealing than any grand strategic narrative: cost. Indonesia's trade with Malaysia alone, two neighboring countries, shared maritime border, deeply integrated supply chains, was being settled through a process that involved converting rupiah to dollars, routing through New York, converting dollars to ringgit, and arriving in Kuala Lumpur. For two countries separated by a strait you can practically swim across, every transaction was taking a detour through Manhattan. The friction cost, conversion spreads, correspondent bank fees, settlement delays, amounted to what Bank Indonesia estimated at 0.8 to 1.3% of transaction value. On bilateral trade worth roughly $27 billion annually, that's somewhere between $216 million and $351 million in pure friction every year for one trading pair. That number puts the entire de-dollarization conversation in a different light. Strip away the geopolitics, the power rivalries, the BRICS rhetoric. Underneath all of it, there's a basic commercial inefficiency that the dollar system imposes on countries that have no quarrel with America, but whose mutual trade has no logical reason to flow through American infrastructure. Indonesia's LCT framework isn't revolutionary. Each individual agreement is modest, but the institutional signal it sends matters enormously. A thoroughly mainstream, Western-friendly, non-aligned country has looked at the financial infrastructure it inherited and concluded that significant portions of it are unnecessary overhead, and it's building around them. The pattern repeats across Southeast Asia. Thailand and Malaysia launched direct baht ringgit settlement in 2016, expanded it significantly in 2023. The ASEAN region collectively has been building a web of bilateral payment linkages: Singapore, Thailand, Singapore, India, Malaysia, Indonesia, Philippines, Singapore, that create redundant settlement pathways for intra-regional trade. The stated goal, outlined in multiple ASEAN finance ministers' communiques, is a unified regional payment connectivity network by 2030. None of this is framed as anti-dollar. The language is always about efficiency, inclusion, reducing remittance costs, supporting small businesses, and that framing is mostly sincere, but the cumulative structural effect is the same regardless of intent. Financial infrastructure that routes around the dollar, built and operated by countries that have no interest in confronting America, but every interest in lowering their transaction costs. This is what makes the current transition different from previous challenges to dollar dominance. When Saddam Hussein switched Iraqi oil sales to euros in 2000, it was a deliberate political provocation by a hostile government. When Gaddafi floated the idea of a gold diner, it was treated, rightly, as quixotic grandstanding. Those challenges came from adversaries, and they were easy to dismiss. The current shift is coming from the middle, from allies, partners, neutral parties, from countries whose finance ministers attend IMF meetings, whose central bankers trained at the Fed, whose pension funds hold U.S. treasuries. They're not rebelling, they're optimizing. And optimization, unlike rebellion, doesn't generate dramatic headlines or trigger policy responses. It just quietly compounds, month after month, corridor after corridor, agreement after agreement, until one day the architecture looks fundamentally different and nobody can point to the exact moment it changed. I need to complicate my own argument here, because if I don't, I'm not being straight with you. Everything I've described and the bilateral agreements, the regional payment networks, the institutional awakening to infrastructure dependency is real. But there's a version of this analysis that dramatically overstates how far the transition has gone and understates how formidable the dollar system's remaining advantages are. The most important advantage isn't technical, it's depth. When people talk about the dollar system, they tend to focus on payments, how money moves from point A to point B. Payments are the visible layer, and they're the layer where alternatives are making the most progress. But payments sit on top of a much deeper structure: capital markets, debt instruments, derivative contracts, insurance, trade credit. And at that deeper level, dollar dominance isn't just intact, it's barely been scratched. Consider global debt. The Bank for International Settlements reported that at the end of 2023, approximately $12.4 trillion in dollar-denominated debt was held by non-US borrowers. Companies in Brazil, governments in Kenya, banks in South Korea, all carrying obligations denominated in a currency they don't issue. That debt creates structural demand for dollars that no bilateral payment agreement can substitute away. A Malaysian palm oil company can settle a sale to India in rupiah or rupees, but if that company has a dollar-denominated loan from a Singapore-based bank, it still needs dollars to service that debt. The payment layer can diversify. The debt layer is stickier. Derivatives compound this. The notional value of outstanding over-the-counter interest rate derivatives denominated in dollars exceeded $108 trillion at the end of 2023. These contracts, swaps, futures, options create an enormous web of dollar-linked obligations that ripple through the global financial system independent of trade flows. Even if every country on Earth settled its physical trade in local currencies tomorrow, the derivative overhang would sustain dollar demand for years. Then there's the question of safe assets. In a crisis, a genuine system-wide panic, where do you park money? The answer, for the moment, remains U.S. Treasuries. Not because Treasuries are perfect. The U.S. debt-to-GDP ratio sits above 120%. Political dysfunction around the debt ceiling has become a recurring farce. The credit rating agencies have noticed. Fitch downgraded U.S. sovereign debt in August 2023, following S&P's earlier downgrade in 2011. And yet, during every recent bout of global turbulence, capital has still flowed toward treasuries. Because the alternatives, Chinese government bonds with capital controls, European sovereign debt fragmented across 20 different issuers, gold with no yield, don't yet offer the combination of liquidity, scale, and legal certainty that treasuries provide. I want to acknowledge this fully because intellectual shortcuts serve nobody. The dollar system has a depth advantage that its competitors are decades from matching. Bilateral payment corridors and regional settlement networks are surface-level plumbing. The deep architecture, the market for dollar-denominated corporate bonds, the euro-dollar system, the repo markets, the Fed's swap lines that function as the global financial system's emergency oxygen supply, all of that remains overwhelmingly American. But, and this is where my argument reasserts itself, acknowledging depth advantage doesn't mean ignoring trajectory. The era I'm describing isn't ending because the deep layer collapsed. It's ending because countries have started treating the surface layer as a sovereign priority. And surface layer changes over time erode the deep layer's gravitational pull. Here's a concrete mechanism for how that works. When Indonesia and Malaysia settle trade in rupiah and ringgit, their central banks need to hold each other's currency in reserve to facilitate those settlements. That's rupiah and ringgit that would previously have been held as dollars. Multiply that across dozens of bilateral corridors, and the aggregate reserve diversification becomes meaningful, not catastrophic, not sudden, but persistent. The IMF's data reflects this. The share of US dollars in global allocated reserves fell from 65.4% in Q1 2016 to 58.4% in Q3 2023. 7 percentage points in 7 years. At that pace, and there's no guarantee the pace holds, you'd be looking at a dollar reserve share below 50% sometime around 2032 or 2033, still the largest single component, still dominant in absolute terms, but no longer majority. That threshold, below 50%, carries psychological weight far exceeding its mathematical significance. And the financial system runs on psychology as much as it runs on math. So, what does the new era actually look like? Not in theory, not in the breathless predictions of dollar collapse that circulate on social media. In practice, in the lived experience of businesses, central banks, and ordinary people over the next decade. I think it looks like fragmentation without rupture, a global financial system that doesn't break apart but develops regional circulatory systems, partially independent, partially overlapping, connected to the dollar system at major junctures, but no longer wholly dependent on it at every capillary. Southeast Asia settles most intra-regional trade through its own payment networks. The Gulf operates as a multi-currency hub, dollar, yuan, rupee, dirham, depending on the counterpart. China's trade with the global south increasingly runs through CIPs and bilateral swap lines. Europe continues using the dollar for transatlantic finance, but builds autonomous settlement capacity for trade with Asia and Africa. The dollar doesn't disappear from any of these circuits. It recedes from the center to the perimeter, from the default to the option, from the infrastructure you use because there's no alternative to the infrastructure you use when it happens to be the best tool for that particular transaction. That distinction, default versus option, is the essence of the era change, and its consequences are concrete. For the United States, the most immediate consequence is fiscal. The dollar's reserve status generates what Valéry Giscard d'Estaing famously called America's exorbitant privilege, the ability to borrow in your own currency at rates subsidized by global demand for dollar-denominated assets. Every foreign central bank that parks reserves in treasuries is effectively lending to the U.S. government at below market rates. As reserve diversification continues, even gradually, that subsidy shrinks. The Congressional Budget Office projected in February 2024 that net interest payments on federal debt would reach $892 billion in fiscal year 2024, surpassing defense spending for the first time in American history. That figure assumes continued robust foreign demand for treasuries. If that demand softens by even 10 or 15% over the next decade, the fiscal arithmetic becomes considerably more painful. For middle-income countries, the Indonesias, the Brazils, the Indias, the new era offers genuine benefits alongside genuine risks. Lower transaction costs on regional trade, reduced vulnerability to dollar liquidity squeezes during Fed tightening cycles, greater monetary policy autonomy. But also, and this is underappreciated, greater exposure to regional currency volatility without the dollar's stabilizing anchor. When every trade settles in dollars, exchange rate risk is concentrated in one pair. When trade settles across multiple currency pairs, the risk diversifies but also multiplies. Central banks accustomed to managing one dominant exchange rate will need to manage 5 or 6 simultaneously. The institutional capacity for that varies enormously across countries. For China, the new era is both opportunity and trap. Beijing wants the yuan to be a major international settlement currency. It does not want the yuan to be freely convertible because free convertibility would mean opening the capital account, which would mean surrendering control over domestic credit allocation, the single most powerful economic lever the Communist Party holds. That tension is unresolvable. China can have a controlled currency or an internationalized currency. It cannot, despite years of creative attempts, have both at full scale. The yuan's international role will grow. It will not replicate the dollar's role. The architecture of control that defines China's financial system prevents it. What emerges then isn't a new hegemon replacing an old one. It's something without clean historical precedent, a multipolar financial system in which no single currency or infrastructure commands the unconscious loyalty that the dollar enjoyed from 1945 to roughly 2022. The closest analogy might be the late 19th century when the British pound, the French franc, and the German mark coexisted as international currencies without any single one achieving the dominance the dollar later would. That era was messy, it was unstable. It also coincided with one of the most dynamic periods of global economic growth in human history. Multipolar isn't necessarily worse, it's just different, and different requires adaptation that monopoly never demanded. I started this by admitting I was wrong 2 years ago. I'll close by telling you what I'm uncertain about today, whether this transition will be gradual enough for institutions to adapt, or whether some shock we can't predict will accelerate it past the point of orderly adjustment. I genuinely don't know. The trajectory is clear, the velocity is not. If that kind of honesty in analysis matters to you, stick around. I go deep on these shifts because the surface level takes aren't worth either of our time.